For more, we're joined this morning by the Chief Market Strategist of JPMorgan Funds, David Kelly. David, back with us for the hour. Great to see you again.
Glad to be here.
John, of course, is with us as well. Are we overstating this industrial revolution from the earnings reports we've seen?
Well, no, I think what we are seeing is a much stronger performance from the manufacturing sector than we are from the service sector. And what that really reflects is the fact that American business has become more competitive. And, you know, people complain about a falling dollar, but this falling dollar and a lot of the cutbacks that we've seen in manufacturing in the last few years has really left us with a more competitive manufacturing sector, and all the numbers on, you know, industrial production, for example, up at the fastest rate since 1997 in the first quarter. That really does reflect a manufacturing bounce back.
And yet, when you're talking about bottom line performance, last time this man was here, he talked about the economic improvements we're seeing, but with the unemployment rate still around 9%. Wage inflation is really not there. And Scarlett highlighted a few companies like United Technologies, a company that had great earnings, and yet they come out today and say, we're still in the process of cutting jobs. So what's your takeaway from that? Does that make those companies attractive investments if they're still cutting jobs?
Well, they don't have to just make money in the United States. I mean, it's a lot of American multinational corporations make a large chunk, and perhaps the majority of their money in many cases, overseas. And so we have a global economic rebound, and American manufacturing is getting a bigger share of that.
So you're saying that the trend in some ways is that, you know, we might see more job cuts, the economy is not that great here in the U.S., but corporate profits are still going to do well.
Well, profits are doing better. Let me be clear, the economy is still improving. I mean, we have now recovered all the output lost in the last recession. The recovery has lasted longer than the recession did. We're creating about 200,000 private sector jobs per month, but it's going to take us about 3 years to recover all the jobs lost. We think that within this year, we will recover all the profits lost in the last recession. At some stage later on this year, I think we'll hit a new all-time high on operating EPS.
But is your view that we have passed that stage of cutting as much as companies can, and we've moved into the next stage?
Yeah, I mean, part of it is, well, it's not just cutting also. I mean, what we're seeing is real wage restraint. People are happy to have a job. They're not asking for a pay increase, and that is allowing companies to hold down their expenses. And I think it's very important. This is a mild, unsatisfactory economic recovery. But profits grow very well in a mild climate. Because what you can get is you can get some revenue growth, but you can hold down all your costs, your interest costs, your depreciation expense, and particularly your wage costs. And that's really what's behind the surge in profits.
You just said all-time high. You believe we're going to get an all-time high in operating earnings?
I think so. This quarter, we thought we were going to hit about $22 in operating earnings. It looks like it's going to be about $22.50. The all-time high was $24.06, and I think that number can go up by about $1 in the second and third quarters. So at some stage, either the third quarter or the fourth quarter, so long as expansion continues, I think we will hit a new all-time high on S&P 500 operating earnings.
And that will tell you what about the value of the market then?
It says the market is still cheap. So long as you believe the expansion gradually continues, then even in a mild expansion, one that where most Americans feel really unsatisfied, the thing that matters to shareholders, which is profits, are going up very well.
So have you recommended since the start of earnings season that investors hold more stocks in their portfolio than a month ago?
I talk to a lot of long-term investors, and I don't like to suggest big switches. The basic point is, if you look at the fixed income markets, interest rates are still too low. If you look at the equity market, people are still too scared of stocks. And so we've really been pretty consistent in saying be a little overweight stocks, a little underweight fixed income relative to a normal portfolio.
I think this is going to be interesting because Scarlett said we're waiting now for the big oil companies to report their results. Those guys have been blowing it out of the water this year. I mean, the sector is up 16%, which would, to me, I know a lot of it's related to the high price of crude, but that would set the bar pretty high, I would think.
I suppose it will set the bar high, but I think the other, I mean, there's also a political issue. I'm afraid when these companies report high
I was just thinking
numbers,
right?
You know, one of the things that has been a barrier to the market has been a sort of a populist rhetoric against big corporations, and I think, you know, the fight against big oil is part of this. So to the extent that it stirs up that populist rhetoric, I don't think that's helpful for the market.
Okay. We are back now with JPMorgan Funds Chief Market Strategist David Kelly. Great for him to fly down here from Boston, right?
That's right.
Okay, and John with us as well. And you agree, right? You think the dollar actually is a benefit, the weaker dollar?
Yeah, I think the dollar is too high, but the whole secret to bringing down a currency, it's a little bit like lowering a piano out of the fourth floor of a building. The whole trick is to do it slowly. And we have actually been doing it slowly. I mean, you know, the dollar has been coming down gradually over a large number of years, and we still have a big trade deficit, and I think this falling dollar is actually helping. It's part of the reason manufacturing is doing a bit better.
You mentioned manufacturing. Which stocks are you recommending investors consider if you think this trend is going to continue?
Well, I don't try and recommend individual stocks.
Or just even industries.
Overall, I think it helps manufacturing in the United States in general, but I think in terms of industries, there's a bigger story. And the bigger story is the economy is going to gradually strengthen. It started off this year pretty slow. We think it's going to strengthen, and that means consumer discretionary technology companies, particularly technology companies, obviously, because of more overseas exports, I think that helps them become more competitive. So those are some areas that I think will benefit both from a falling dollar, but also from a stronger economy here at home.
Right, but there's plenty of people who disagree with you and say, look, when you get a falling dollar, you've got inflation.
Yeah, but let's this dollar oil thing. Let's talk about that for a moment.
Okay,
how much are oil prices up
over
the last year? Maybe 60%. I mean, I don't have the numbers in front of me, but about that. If the dollar's down, say 10%, it's obviously not the dollar that's pushing up oil. You know, if you think about it, okay, the U.S. consumes about 25% of the world's oil. So all other things being equal, if you think about the math, if the dollar falls 10%, then if oil is constant in world prices, it should go up about 7.5%. It shouldn't go up 10 times as much.
So you're saying there's not a direct inverse correlation?
There is an inverse correlation, but that's a small part of the story. The big part of the story is we're just not producing enough oil. There's an oil shortage, this problem in North Africa, and people are worried about it and investing in commodities and in oil to try and hedge against it.
How does the dollar affect investing overseas, or overseas investors who are thinking about investing in the U.S. and maybe get frustrated by that?
It gives you a nice little benefit to investing overseas. I think it helps international stocks. I mean, all other things equal, if the dollar falls 10% overnight, your European stocks are worth 10% more in the morning. So I think it helps with international investing. It also helps with things like emerging market local currency debt. Because I know that these countries are fighting inflation, but as they let their currencies move up against the U.S. dollar, that should help with the value of their local currency debt.
But on the flip side, are there investors overseas who won't want to invest in the U.S. because they're worried about the U.S. dollar sliding?
Possibly. But we've got so many investors in the United States who are sitting in cash and sitting in fixed income in very safe investments who ought to be in them. There's plenty of money to go into the markets if people have a mind to do so.
Okay, but I'm still fixated on this. I know we're running out of time, but if the dollar slides another, 5% or so, you're just not worried. You're not factoring that in.
I am factoring it in. It gives us a little bit more inflation, but it's not. It has never been the biggest deal in the U.S. economy. We only import about 15 or 16% of our GDP. So if the dollar was to fall 10%, it adds 1.6% to our price level. It's not that big a deal. This is not a small open economy. It's a big, relatively closed economy. The dollar simply is never the most important story.
Okay. And some new developments I want to tell you about in the battle for the New York Stock Exchange, where Laura is. It follows a prediction from Duncan Niederauer, the chief executive of NYSE, that savings from the proposed merger with Deutsche Börse will be much larger than originally forecast. This morning, though, the NASDAQ Intercontinental Exchange, well, they hit back. They said the New York Stock Exchange shareholders should be highly skeptical of Niederauer's claims. And they obviously need to be a little bit more specific on why. You know, last time you were on, I think it was actually when the deal was announced, right?
Yeah, that's correct.
Okay. Anyway, all right, let's get back to the markets, though. I know we talked a little bit about earnings before.
Yeah.
Is there going to be anything more interesting coming out of earnings? You know, we talked a little bit about the oil companies and stuff, but is there going to be anything more interesting out that we already haven't seen?
Well, I think we still have to look at the revenue numbers. I mean, we're going to get a GDP report later on this week, which is going to be very weak in terms of, top-line GDP growth. And what's interesting is the ability of American companies to find ways of growing revenues from around the world, even at a time when the domestic economy is frankly pretty squishy. And this year, they're actually up now to 10 and 11, so they're already coming back. The economy's not quite there yet, but the point is this. It looks like GDP on Thursday is going to be something like 1.5% in real terms, which is really weak. But there are a lot of special factors in there, and over the course of this year, I think the economy will actually grow by more than 3%. So I think things will pick up after this point, but it did get off to a pretty slow start.
Todd, are you as, I guess, as optimistic about the markets?
Well, I like the analogy, and I think that first quarter GDP, yes, it's going to be weaker than I think we had hoped 6 or 8 months ago. But yeah, it's the beginning. It's one step of 4 this year, and I think that as we continue to see the economic data improve and whatnot, things will get better. The big problem here is how low can the dollar go and how low can implied volatility go in the equity and the treasury space? I mean, right now,
that's
pretty much
our
best indicator.
Todd, I guess the question is, do you really think that a falling dollar is that much of an obstacle for the economy overall? I mean, I know it affects markets, but what is wrong with a slow slide in the dollar?
Well, a slow slide is one thing, but we're going back to 2008 lows. And I think that as long as we keep the interest rates at zero, the dollar really has very little upside here. We see things changing in Europe. We see things the way they're moving in China. And I think the dollar right now is the best indicator of confidence in the U.S. economy. And right now it's not there.
David, you know, one of the things I've thought about, and I don't know if I'm exaggerating this, but, you know, this whole QE2, right? In some ways, when it stops in June, or in July, I think it is, you know.
Yeah, June 30th.
June 30th,
yes.
right. Is it almost going to be like the markets are going to, or we're going to finally see what it's really like, right? It's like the emperor with no clothes all of a sudden.
I still don't think we're going to quite see that, because there are other questions. There's a question of, you know, does the Federal Reserve has been building up its balance sheet. Now, does it allow it to gradually drift down, which it would do if it, for example, stopped recycling maturing treasuries and maturing mortgages, or does it recycle those back into treasuries so we sort of hold it here at a plateau? In either way, we still got a really extraordinary monetary policy, a really extraordinary fiscal policy. So I think we're very far from normal right now in terms of both monetary and fiscal policy, and so we're probably very far from normal in terms of a normal treasury environment.
And a normal stock market, then?
Yeah, to some extent. I mean, I think it also reflects the fact that investors are concerned about. I mean, people are so pessimistic about the economy and stocks that I think that is somewhat reflected in the extraordinary monetary and fiscal policy. So, yeah, we're very far from normal.
Okay, because what I'm trying to get at is at what point then will we start to see, you know, what's really going on in the stock markets? You know, what is really investor sentiment? And is that at the point where we're going to see people come back into the market?
Oh, yeah. Well, at the moment, 2/3 of Americans think we're still in recession. Investor sentiment
according to who?
According to Rasmussen. They do nightly polls on consumer sentiment, and essentially 2/3 of Americans think we're still in recession. And I think that is indicative of a very negative attitude, not just among consumers, but among investors. People would rather overpay for a bond than underpay for a stock. And so I think the attitudes need a lot of adjusting, but the earnings, they're pretty real. The economic rebound, it's slow, but it's real. So I think that part of it is real.
Okay. David, great to see you.
I'm glad to be here.
I know you're flying back, right, today?
Yes, I do.
Okay, David Kelly, we're going to have you back on again of JPMorgan Funds.